Just this week, we saw the Fed hold rates. We saw the provincial tenancy laws backpedal on their own legislation that was enacted a mere 2 weeks ago. 30-year amortizations have kicked in for first-time homebuyers, and the all-important 5-year Canadian bond hit an 18-month low. And if it wasn't already that obvious, Canadians are being taxed to death, and there is new data to support that sad, sad fact. Plus, the July real estate numbers are out, and the average home price dropped $60,000. What a week it's been. Let's dive into how all of these changes are affecting Vancouver real estate. Off the top, number one, the Fed. So on Wednesday this week, the Federal Reserve held its key interest rate, held it steady. But they definitely signaled that it could start lowering as soon as September amid what they say being easing inflation and a cooling job market. Quote from the Fed Chair Jerome Powell here. The economy is moving closer to the point where it will be appropriate to reduce our policy rate, he said at the news conference. Going on, that time is drawing near. That time could be September if the data supports that. Well, just 2 days later, on Friday, the US jobs number came out and they added only 114,000 jobs in July. And that was well short of the 185,000 that was expected and much, much lower than the 206,000 jobs that the states added in June. So their unemployment rate got pushed up. It hit 4.3%, which is actually the highest level it's been since October, dating back to 2021. And it's up from only 3.7 earlier this year. Okay, that trend has triggered a recession indicator known as the Sahm Rule. I think I'm pronouncing that right. It's spelled S-A-H-M. If I'm butchering that, please correct me in the comments below. But the Sahm Rule, which essentially says that a rise in the unemployment rate by 0.5% within a 12-month period typically precedes a recession. So all of a sudden, the big R lights are flashing in the States. And interesting that this happened just 2 days after a rate hold. And understandably, first, that sent the markets essentially into a bit of a free fall here, with the NASDAQ dropping 10 points, 10% off of its recent all-time high. And the markets also then expected almost a certainty of that rate cut at their next announcement, which is coming quite soon here on September the 18th. On top of that, the markets are pricing in rates below 4% within the next 12 months as well. Understandably, cuts in the US would kind of counterbalance the recent cuts from Canada and somewhat open the door for Canada to feel okay to push further rate cuts throughout the rest of 2024.
I think if we end up seeing a rate cut in the US, that closes the gap in terms of currency deviation. So if that actually happens, then we can continue to lower without having to sacrifice and import inflation. So that it's important news for us to be aware of. You know what else is important news? Is the updated tenancy laws. And I say it kind of comically because it's only been less than 2 weeks after being enacted, and the tenancy laws are changing again. We've discussed this probably ad nauseum, but the notice to vacate a tenanted property went from a full 2 months to a full 4 months, creating a scenario where many home buyers' mortgage pre-qualification would expire prior to the possession date of them actually trying to find the property and writing an offer on it. Tenanted properties were already very low on the list of targeted properties for buyers. And now a 4-month change dropped that appeal even further. Anecdotally, I'd say about 100% of my clients right now are avoiding tenanted properties. I said 100%. And that sentiment has been reinforced by just about every other agent I've been talking to over the last couple of weeks. And it appears the new government regulation was, once again, enacted without any consultation from the real estate industry. The uproar was so big when it was enacted, and the errors so profound in the legislation that it took only 2 weeks for the government to amend it. The rules for vacant possession are now 3 full months, not 4. And though this will barely move the needle when it comes to tenanted properties, they'll still be overlooked for vacant ones or owner-occupied units. I mean, let's not forget here the legislation is reminiscent of other rules implemented without consulting the industry or the real estate board for that matter. You had foreign buyers ban, you had the rescission period, and you had dual agency, all resulting in the BC REA pushing back after the fact as they weren't consulted. And there's a good reason to consult. Now this government has been an entire embarrassment. And I personally just don't trust what they're coming out with next. I don't think they're going to solve the problems. And to me, it's a bit of a joke. It's a bit of a laughing matter. I even had clients reach out today being like, is this actually happening? Pretty crazy.
Yeah, the trust factor, trust comment's an interesting one, because what's stopping them to changing it to 5 months in another 2 weeks or something equally ridiculous? Because it appears right now, or at least recently, government is just sort of waiting to the squeakiest wheel. And tenants were the loudest, so they protected them more with what appears to be zero consultation with any industry professional who would have at least given a counter argument or balanced it out and made them understand how much they were affecting that side of the argument as well. And I guess now it's been heard and they backpedaled. But either way, why not just do this right out of the gate? It would have taken the same amount of consultation to get to maybe a similar outcome. Either way, here's another genius move by our powers that be, if you will. As of August 1st, as of Thursday this week, when it comes to affordability, Krista Freeland has championed this idea. And what it is, it's taking first-time homebuyers and giving them the ability to get a new mortgage that instead of a 25-year amortization, it's extended to a 30-year amortization. Understandably, the more time you have to pay something, the smaller the monthly payments get. And in Krista Freeland's eyes, this makes homes more affordable. But let's dissect the obvious mistakes in that. Yes, sure, absolutely. If you buy the same priced home, your payments do come down. Absolutely true. But that extra 5 years of payments, understandably, creates a much higher interest payment period as well, making that home, if you paid it over that same 30 years, well, higher. Okay, you're paying more for that same home and taking longer to pay it off. The total buying power by shifting the extra 5 years of amortization does increase a home buyer's buying power by about 5%. But what happens there? They don't just keep the same payment, they buy a house that's 5% more expensive. That's typically what we see here. Keep in mind, it's over 90% of people buy at the absolute top limit of their pre-approval mortgage amount. Digging a little deeper on this, and we have discussed this before, but because it's just been enacted, let's refresh everyone's memory. In order to qualify for that, you must be a first-time home buyer. You must put less than 20% down, meaning the property must be worth less than $1 million. But here's the weird kicker. It only qualifies for newly built homes, brand new, which typically means two things. A, it has GST on it. So now you're making the home buyer pay an extra 5% on top, even though you've just increased their buying power by 5%, you're kind of charging them an extra 5%. So there's a complete cash grab there by taxes, in my opinion. And buying a newly built home, if you've ever tried to buy a pre-sale condo or even a home in Greater Vancouver, the vast majority of them require 20% down, and they don't allow 20% down. And of course, the average home here is $1.2 million. Sure, first-time home buyers typically don't buy those, but it's all optics to me. I don't see more than half of 1% of people actually taking advantage of this. And from what I can tell, it's more lip service as opposed to any consultation taking place with the real estate industry to say, well, how do we actually make this work? How do we actually take 25-year AMs, make them 30, and help first-time home buyers? We'll let them have access to any property would be a simple one, right? Let's avoid the GST. Let's avoid the 20% pre-sale, typical down payment amounts, etc. But who wins here, right? It's the banks, obviously, right? It doesn't make anything more affordable. Instead, like I said, you pay more interest over a longer period of time. And realistically, I think this is being done for votes, and this incentive, if you will, it's going to die out a hard, bitter death, just like the first-time home buyer savings account did. Have you heard how that worked out? Of course not, because it didn't. It was a complete flop. These ideas, these incentives, these promises of affordable homes, it's just for votes. It's not for homes. But you know what would help make housing a little bit more affordable? It's of course what it has always been. It's cheaper credit. It's not that it's even more affordable. It's just more likely that people will buy with cheaper credit, i.e. access to mortgages and lower rates. On that front, the all-important Canadian 5-year bond, well, like I said, it dropped to an 18-month low today, hitting about 2.89%. This means you can expect fixed rate mortgages to drop as well. They'll probably be in the mid 4s by as early as next week.
You know, Dan, the one thing that really often makes houses cheaper or more affordable is more houses. And I know that we've said that I don't know how many times, but the truth is the truth. I mean, you can't reinvent this stuff. There's clearly no ability here from our federal government and their ability to have a creative financing solution for people who are trying to get into the market for the first time, second time, third time. Why are we segregating? Also, who are we protecting? Why is it only new homes? Why isn't this across the entire marketplace? You know, the questions that come out of this are you know, recognizing that the thought process is not developed, that the consultation hasn't happened. It's really unfortunate because there's been so many opportunities for the Liberal government to come out and actually do something here. And the one thing they need to do, which is build more houses, is the one thing they keep not doing. And it doesn't, I don't understand. I don't know how many times they need to hit their head against the wall here. Now, you're not wrong, though. When it comes to cheaper credit, that'll certainly help people more than anything else because, again, if you're paying principal as opposed to interest, at least you're paying down your debt. Whereas at the current rate here, you know, interest is just, it's too high. Anyhow, speaking of which, Canadians are certainly feeling like they're taxed to death. I mean, every month, every few months, it feels like a new tax is being enacted. If it feels like you're paying more taxes than ever, then you're right. Because as of last month, Canadians now pay more in taxes than shelter, food, and clothing combined. That's right, 47% of your income is going to taxes. You know, and here's the thing. I was actually talking about this with a couple people yesterday. I don't think Canadians actually have a really hard time paying their taxes. They do when they're so high, but they would feel better about it if they got something in return. But instead we get, you know, a corrupt investment. We get billions of dollars that go missing. We get infrastructure that doesn't help. We get ideas and creative financing, quote unquote, that hasn't solved any problems. So it's really frustrating to pay 47% of your income to taxes when you don't get the improvements. When have hospital beds improved? When do we talk about teachers' salaries? They can't even afford to buy a house. You know what I mean? It's just not working. It feels broken. I mean, essentially, you're working 6 months of the year just to pay the government to go and misappropriate your money. So the frustrations with this are exemplified by the fact that the government has grown by 43% under Trudeau's reign, and cost overruns are rampant. Here's a prime example of why we should be letting the competitive marketplace run this and not the government. The North Shore wastewater treatment plant was budgeted at $700 million, but costs have soared to almost $4 billion. And kind of this like, oops, let's just charge the homeowners the balance. We'll just make it up over there. It's insane. How do you expect people to save for a down payment and enter the housing market when almost half of their income goes to the government? And then you charge things like GST, PTT. I mean, on a new property, you're looking at least 33% of that going to the government as well. It's crazy what's gone on here. Anyhow, I digress because I'm getting heated.
It's easy to get heated, and when you consistently hear of these cost overruns and just absolutely no responsibility taken and no changes seem to happen. And maybe all this tax being paid is what's pushing home prices down because people can't afford to do anything but pay their taxes in just their homes. So, hey, here we go. Let's dive into the July numbers because they are fresh off the press, as they say, as of today. And as always, we will start with the quote unquote health of the market. How many homes are selling in the month of July? That number hit 2,333. It's about 5% less homes sold than July of last year and 5% lower than the month before. Let's pull out. Let's look at the big picture here. And home sales still slow, 17% below that 10-year average. So this is now the third month in a row where we're seeing home sale volumes decline. And realistically, it's been the whole theme, the whole premise of 2024, if you will. It's slow sales. The 2 rate cuts that we've seen so far this year have simply not stimulated buyers. And you can expect to see continued sort of 17-20% below 10-year average sales to continue absolutely into August and quite likely into September as well. It kind of feels like the market is grinding to a halt, right? These 2 years of rate hikes are fully in effect now, and it's still kind of tightening its grip, if you will. Let's flip the switch though, because Vancouver is also known for pent-up demand. So cycle after cycle, we see it, right? It slows down, it takes off, it slows down, it takes off. And really, cycles are all but guaranteed, but what's different is how extreme they are up, how extreme they are down, and of course, how prolonged or not they are. So right now we're seeing this marketplace where increased home options exist because of course there's more inventory. We've got lower rates forecasted over the next 18 months. So I guess what I'm asking is when will sales tick up again? Is it going to be fall? Is it going to be spring of next year? Is it going to take till 2026? We don't know. We're not sure yet. But again, we do know it will happen at some point because that's just what the cycle does. And interestingly, when you look back at all the data we have going back to the 70s, historically, the longer the pullback, the larger the resurgence. It's almost like a pendulum, right? If it moves just a little bit, it only comes a little bit back. But if it swings way out and it gets extreme, either to the down or the upside, look out, it's likely coming back the other way. But for now, the high cost of living has fewer and fewer people thinking that it's a good time to buy a home. And we're going to continue to see low sales volumes for the foreseeable future.
I hope that's the case, Dan, with our taxes too. They swing all the way out here. Maybe they'll swing all the way back. But the truth about taxes is that usually once they're implemented, they never go away. That said, let's look at new listings here. So ended the month with 5,597 new listings. That's a 20% increase year over year and a 3% decrease month over month. This is the third month in a row of decreasing new listings, but we're still 13% above the 10-year seasonal average.
So as mentioned, I think about 3 weeks ago or something like that, I was all but certain that inventory was going to hit a 10-year high, at least for a couple of weeks, if not days during the month of July. As mentioned last week, I was wrong. It never really got above about 15,100, and we wanted to see 15,600 to be that 10-year high. Well, now that the dust has settled, the sales are in, some of the listings have expired, some have been pulled off the market, likely for September or October. Total inventory at the end of July was like 13,724. That's actually down month over month. So it dropped from June into July and was actually the first inventory decline in 7 months. That surprises me. But realistically, we're talking a hair, right? It's down a hair. I think it was down 20 listings or something like that. Big picture, though, way up from last year, right? There's way more homes on the market. So much so, it's almost a third more, 32% increase in active listings year over year. And understandably, that's well above our 10-year average, like 20% above the 10-year average. Detached homes. This is something a bit interesting and something that we're kind of following closely here. Detached home inventory increased and is sitting at a 5-year high, but townhouse and condo inventory decreased. Condos decrease. It's weird because, you got to think on one side, the building permits for detached homes are at basically historical lows, 40-year lows, if I remember correctly from last week's episode. And yet they're not getting snapped up in a sense. We've actually seen detached homes, which essentially are just not being built anymore. That inventory is increasing. So there's a weird segment in the market right now for people who maybe were considering keeping an eye on detached. There's a bit of a crossroads here to pay close attention to. And if it's something that you've been considering, definitely book a call with us and reach out, because we're starting to spot some opportunities here. But let's move on. As I mentioned, these condo inventory in Vancouver actually dropped, and it's always fun to go and reference Toronto and what's happening there, because Toronto inventory overall, well, guess what? They just hit an all-time high record across the board. There's almost 25,000 active listings in Toronto right now. And then you compare that to here, GVRD, we're actually 35% below the all-time high that this area ever saw, which was back in the GFC in 2008. And as mentioned, the inventory actually lowered in July compared to June. So it's a complete divergence of what's happening in the GTA compared to the GVRD.
Very fascinating, actually. It's fascinating because usually the markets tend to follow each other. Vancouver tends to follow Toronto. So it's interesting. I think maybe we're starting to see a lot of the increase in population moving into Vancouver and creating more and more, or exposing more and more of its geographical constraint than anything else. We'll see. We'll see how this continues to unfold, especially the single market or the single family market. Interesting to see that those levels increase and soften to the degree that they have. Anyhow, moving on to sales to active here. Overall, we're sitting at 17%, so sitting in a balanced marketplace here, down 1% month over month. This is the fourth monthly drop in a row, so we certainly have a trend here, and the second month in a balanced marketplace here. To break it out into asset type here, we've got 13% for detached. That's hovering right above a buyer's market. It was the same as it was last month. 22% for townhomes, that's down 1%, and 20% for apartments, also down 1%, reflecting that sentiment in the marketplace where things are slow. And it's evident here in the numbers as well.
So let's move into price. Always interesting here. It's like Vancouver real estate, it just won't move sideways. It's always doing something dramatic. And we saw that this month with prices. So HPI down for the second month in a row. And it dropped pretty significantly, like 0.8% drop in the month of July. I mean, that's almost a percent. Or if you annualize that, you're down 10% on the year if it were to continue at that pace. So it was a significant drop last month. And interestingly, that 0.8% month over month, it's actually where we are year over year as well. So we're basically negative on the year now. These HPI home prices just tucked under 1.2 million at like 1197. Median also dropped. It dropped 10K, sitting at 970,000. But as mentioned off the top of this episode, average prices got absolutely hammered. And this is what's wild and what we talked about Vancouver never being boring when it comes to real estate. Last month, do you remember when we told you last month the average home price in Vancouver was an all-time high, higher than 2022? Massive number. And yet this month it got hammered, got pushed down $60,000. So average home prices now sitting at $1,350,000. 60K, I mean, it's a dramatic drop. The last time we saw that big of a drop in average home prices, it was just after the rate hikes started and the whole market just froze. So it's been about 2 years since we saw that big of a drop, and it's pretty big. Pretty big. So expect, I think, a continual downward trend in prices over definitely August and quite likely in September. And then we'll see what happens with the rate cut or not in that month.
Yeah, I think the rate cut will be interesting in September. I also think, we're 2 months away then from an American election. And historically, if you look at the cycles in American elections leading up to the American elections, markets typically soften, slow down, transaction levels, everything slows down. And then the election will take place. We'll see what happens at that point. Though I think afterwards, you're going to have another 4 years of relative certainty from a policy perspective, at which point markets will probably respond well to that. So I suspect we'll see it'll be slow, likely through September and October. And I think it'll take well into 2025 before we start to see a dramatic change in the temperament of the marketplace. with that said, that's just my opinion, though. Feel free to let me know what you think. With that said, though, days on market here, we're sitting at 17. It continues to climb up. This is the highest we've been since February, and I think that'll continue to go up.
So that's the wrap up for this week. Understandably, the economies now north and south of the border are seriously feeling the pain from the rate hikes. Joblessness is becoming a serious issue, as I think we identified probably a few weeks ago here. Champion rate cuts if you like, but they only happen when the economy is hurting, right? It's a double-edged sword for sure. So some people will benefit and some absolutely will not. But either way, I think we're seeing the trend that we felt in Canada for months and months trickling over to the States. The countries take a long time to turn around, and right now they're heading down. So they're going to have to do something to correct course, if you will. And the number one tool they have to do just that is rate cuts. So I feel pretty firmly, based on this week's economic data, that we can expect further cuts through the rest of 2024. And what that does to housing, we'll see. So far, not much, but nothing moves ultra quick when it comes to that. So thanks as always for tuning in. Enjoy. Hey, BC long weekend. Have a great long weekend. Weather looks great. Get outside, and we hope to see you here again next week. Thanks.